All right, today we're going to be covering some characteristics of an insurance contract. So this is going to be covered in Chapter 1 or Chapter 2. So a few of the terms we're going to be covering are unilateral contract, contract of adhesion, ambiguities in a contract of adhesion, and lastly, aleatory contract. So a few of the terms that can get a little bit tricky on the exam that are similar in the way in which the questions are asked are a contract of adhesion and a unilateral contract. So these have very similar definitions and they're very, very easy to mix up in the exam questions. So I'm going to give you the definitions and we're going to go over a few example questions and hopefully I can give you some keywords to look out for so you don't get mixed up on exam day. All right, so what's the definition of these two terms? So contract of adhesion, this is where one party, which is the insurer, prepares the contract and submits it to the other party, which is the insured, for acceptance. And where the word adhesion comes into play is where the insured cannot make any changes. So what you want to think about with adhesion is think it's stuck, right? Think adhesive tape, right? It's stuck. So the insurer, the insurance company, is preparing that contract and the insured cannot make changes to it, right? They just either have to take it or leave it. The best example I can give you is with the premium, right? So when we accept our, say, car insurance contract, right? And that contract that we signed that we agreed to, say the premium is $300 a month. We cannot take that home and say, well, you know what? I'd rather pay $100 a month. Let me just scratch that out and change it, right? It's stuck. It's once you've accepted it, you cannot make changes to it. So one party, the insurer, submits it to the other party, the insured, for acceptance, and the insured cannot make changes to it once it's been accepted. So with adhesion, you want to think it's stuck, right? The one party prepares it, the other party can't change it. Now, the other term that's similar is the unilateral contract. So it starts off kind of similar. Only one party is legally bound to perform any duties once the premium is paid. Only the insurer makes a legally enforceable promise. The insurer is legally bound to perform duties, and the insured does not make a promise but pays the premium. So you can tell it kind of sounds similar. They're both talking about one party doing something. But the difference there with unilateral is where one party is legally bound to do something. Yes, the insured has to pay that premium, right? And if they don't, the insurance company is going to cancel that policy. But only one party is legally bound to do something that's in that contract, right? One party, being the insurance company, is legally bound to pay the claims. That's what makes it a unilateral contract. So when you think about unilateral, first thing you want to think about is right, or uno, think one party being the insurer. And the next thing you want to think about is anytime you see questions about unilateral contract, think of the words like legally required or required. So they go hand in hand with legally or required versus contract of adhesion. Think it's stuck and the insured cannot make changes. So let's look at some example questions. So first one here says ambiguities in a P&C contract are resolved in favor of the policy owner because an insurance policy is, this one's going to be C, a contract of adhesion, right? Why is it going in favor of the policy owner? Because it is a contract of adhesion, because it is stuck. And I'll talk more about the ambiguities and how that ties into a contract of adhesion here in a second. So what is a contract of adhesion? So again, a contract of adhesion is written and the terms are decided by only one party, right? The insurer wrote that policy that was decided by them, by the insurance company, that one party, and the insurer cannot change it, right? So again, think of stuck. Down here, we have an insurance policy is unilateral because this answer is B. Only the insurer makes a legally enforceable promise, right? So there's that term, legally enforceable. So you want to associate that with unilateral, right? Anytime you see anything about legally or required, that is where your unilateral comes into play. Same thing with this next question. It says when only one party, the insurer, is required to perform when the insured meets policy conditions, it's called. So again, it's talking about that one party, but it also says required, right? So we know that's unilateral, not a contract of adhesion, because it's not talking about the fact that the policy cannot be changed. It's not talking about the fact that the terms are decided by one party. It's talking about the fact that only one party is required to do something, right? Making that legally enforceable promise. That is unilateral contract. So I hope that helps with seeing the example questions and, again, associating those keywords. So adhesion, think stuck. One party prepares it. The other party, being the insured, cannot make changes. That's contract of adhesion. Versus unilateral, you want to think about the one party, again, being the insurer and being legally or required to do something. That is for the insurer as well. That makes it a unilateral contract. Next up, let's look at ambiguities in a contract of adhesion and also what is an aleatory contract. So aleatory contract, this means there's an unequal exchange of consideration. So with the exam, you're going to see the term consideration. That typically means anything of value. So it could be literally money, right? It could be the insured paying the premium. It could be the insurer indemnifying the insured for a claim, but it could also just be anything of value. It could be the insured signing something on the contract because it's of value. So consideration, again, is something of value. So unequal exchange of consideration, there's a chance of loss or no loss on any policy, right? We don't know. We don't know what's going to happen in a contract, right? The insured could pay a $500 premium every month and never have a claim, or it could go the other way. They could pay a $100 premium every month, but the insurance company can end up paying thousands of dollars in claims, right? That's what makes it aleatory. It's unequal. And a good way to remember that is if you picture this L in the word aleatory, picture that the letters on each side are unequal, right? So the A on one side, and then on the other side, you have EATORY, right? Something silly, but hopefully that'll stick. So that makes it unequal. It's an unequal exchange of consideration. And then we have ambiguities in a contract of adhesion. So we got a little bit of a preview in this example question here, but let's look at it more in depth. So ambiguities in a contract of adhesion says that any doubt or ambiguity found in a policy will be found in favor of the insured because the insurer, the company, wrote the language. So as you can tell, this kind of ties into that contract of adhesion, right? So what it's saying is that any ambiguities, if there's anything that, let's say, goes to court, it's always going to go in favor of the insured because the insurance company wrote that contract, right? So the insurance company cannot turn around and say, well, I didn't understand what the contract said, so I interpreted it this way. They can't say that, right? Because they wrote the contract. The insured can, right? The insured has to interpret that contract, right? Because again, it's a contract of adhesion. They can't change it, right? They kind of just have to take it or leave it. So in a contract of adhesion, any ambiguities are going to be in favor of the insured because it's stuck. They had to just take it as is. So they kind of go hand in hand. So a good way to kind of remember that is think the A and A. So anytime you see questions about, why do any ambiguities found in a contract go in favor of the insured? The answer typically is going to be because it's a contract of adhesion. So ambiguities and adhesion kind of go hand in hand. So let's look at some examples of that. So this one says, which statement best describes a contract of adhesion? And the answer here is B. It says ambiguities are interpreted in favor of the insured. So you can see A says in favor of the insurer, which no, right? It's in favor of the insured, again, because they can't change it, right? The insurer wrote the contract, the insured cannot change it. And then next question is an aleatory contract means, and this one is C, performance depends on an uncertain event, right? We have that unequal exchange. We don't know what's going to happen, right? It's uncertain if the insured maybe will end up paying their premium every month and never have a claim, or it's uncertain if the insured will pay that premium every month and rack up thousands of dollars in claims, right? We just don't know. It's an unequal exchange. We don't know what's going to happen. It's an uncertain event. So quick recap on what we covered. We talked about unilateral contract, contract of adhesion, aleatory contract, and the ambiguities in a contract of adhesion. So unilateral contract, you want to think about, first up, you want to think about un, right? Or uno, think one party, right? That one party being legally responsible or required to do something. That's always going to go hand in hand with unilateral. Contract of adhesion, you want to think about the word adhesive, right? Being stuck, that one party being the insured. The insured is kind of stuck, right? They cannot take that contract home and change it. The one party that prepared the contract is the insurer. Contract of adhesion, again, goes hand in hand with the ambiguities found in a contract of adhesion. So again, think kind of A and A. And why is that? Because contracts are adhesive, right? So any ambiguities are going to go in favor of the insured because they cannot change it. The insurance company wrote that contract. The insured had to just interpret it as it was. And then lastly, aleatory contract, it's an unequal exchange, right? It's unknown what's going to happen in that policy. So I kind of drew it out for you to kind of explain what I was saying to help you remember that. Picture that L in the middle being a line and the letters on each side being unequal exchange of consideration or money. I hope that helped explain some of those concepts for you. If you're looking for anything more in depth, we have a ton of resources out on our website, a full on-demand program where I literally go through every single chapter, just like I did here, but literally for every chapter. That has over 10 and a half hours of videos for business owners, P&C basics, concepts, CGL, auto, dwelling, homeowner. So if you're looking for a more in-depth learning and education, definitely check that out. We also have a practice exam that has over 100 questions, also includes a video just like this where I'm going over what those questions are and explaining why the answers are what they are. We also have a study guide. We also have a bundle, practice exam and study guide bundle together. So anything you're looking for to help you pass, go check out our website. Wishing you the best of luck. You got this. I know it's hard, but you got this.